Welcome to today's webinar on conditions in the professional services sector. I'm Haley Schnander with the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have just a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Joe will be entertaining questions at the end of his presentation, so if you have a question, please type it in the chat box on Zoom. We'd also love to get your feedback at the end of this presentation as well, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Joe.
All right. Thank you, Haley. And thanks to everyone in our audience for joining us this morning. Happy August and happy Friday. I'm going to be sharing the results of a survey that we do on an annual basis with our partners at the Minnesota Department of Employment and Economic Development. And I'll just get right into that. This is our annual professional services survey. Before I get into the results of the survey and the rest of the show, I just want to give our standard disclaimer that my views are my own and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. I'll try and avoid expressing too many opinions in general, but I just want you to keep that in mind. So before I get into the results of the survey, I'll just talk about exactly what sector of the economy we survey. This isn't a general economic survey like some of the others that we do that some of my colleagues will be presenting pretty soon. This is a survey that's focused specifically on the professional services sector. So I'll talk about what I mean by that before I get into the survey results. What we found in the survey, just to kind of get the results, the headline results out there right away, is that we saw positive but mild growth over the last 12 months among professional services and business services businesses. And the outlook for the coming 12 months is actually somewhat optimistic given the slight growth that happened over the last year. And we had a special question on labor market conditions, and the big, maybe somewhat surprising result on that is that the labor market for these businesses is still pretty tight. So I'll get into some of the details on that a little bit later, but that's kind of the headline results. Before I get into the rest of the show, though, I do want to take an opportunity to promote our Business Pulse survey. That's a different survey that I'm presenting this morning. This is a monthly survey that we conduct of businesses in our region. You can find this survey results on our website at minneapolisfed.org on our survey landing page, and you can kind of see a screenshot of that right here, just to kind of give you an idea of what this looks like. We track conditions on a monthly basis across a wide array of businesses around the region. And if you're interested in signing up, Haley has posted a link in the chat. If you are a business owner or a manager of a business of any size, we would love to have you join our panel and share with us, give us real-time economic insight on what's happening in the economy. It's very valuable to our policymakers at the Federal Reserve. And so you can find out more about how to sign up if you just if you click on this QR code or use the link that Haley posted in the chat, and she'll post that again later in the slideshow this morning. I'm not going to belabor too much more context with you, but I just want to review with you when I talk about the region. This is a regional survey, not a national survey. And when I talk about the region, I'm talking about the Federal Reserve's 9th district. So that includes Minnesota, but also the states of North Dakota, South Dakota, and Montana, and then portions of Wisconsin, the Upper Peninsula of Michigan. Our district is one of the Fed's 12 districts. Many of you in the audience have attended our webinars in the past, so I'm not going to dwell on that point too much. So a little bit of background on the services sector. This is a survey that we do on an annual basis. It's a complement to a survey that we do toward the end of the year of manufacturers. Manufacturing, pretty straightforward. Services is a little bit more amorphous. We're surveying a large sample of firms in the following sectors that you see up on your screen. That's primarily in the professional, scientific, and technical services, and you can kind of see a list of these, but these are your advertisers, your engineering and design firms, legal services, accounting, things of that nature, and then also administrative and support services. These are kind of business to business type of services. So a pretty broad array of mostly business-focused companies that are serving other businesses. So it's kind of a good pulse on overall business activity, even though it's a relatively small slice of the overall economy. I don't want to overemphasize how small it is. You can actually get an idea of the size of this industry if you look at a breakdown of our GDP, both nationally and in the 9th Federal Reserve District, and you can see that here. Nationwide, these sectors account for about 13% of total U.S. output, and in our district, slightly less at about 11%. So it's not a huge share of the economy, but a significant one. And again, these are businesses that serve other businesses. So we get an idea just based on the demand that they're seeing about what's happening in the economy and in the business and in business conditions more broadly. So we think it's a pretty valuable survey to do. Also, it's worth noting that they do employ a lot of people in these industries as well, and a growing share of the labor force. You can see that in the most recent month for which we have data, that's June 2025, which we have state level data. We just got July employment data this morning. We don't have that at the state level yet. These industries employ about 14% of the total labor force nationally, and about, again, 11% in the 9th district. So again, a significant, if not overwhelming share of the economy. So now to get into the survey results, a little bit more about this survey. Like I mentioned, this is a survey that we do with our partners at the Minnesota Department of Employment and Economic Development on an annual basis. This is actually follows the best practices of survey science. It's a random sample. It's stratified by state and firm size. It's a large number of businesses that we get from a private database. And the way the partnership works is our colleagues at Minnesota DEED conduct the survey in Minnesota, and then we at the Minneapolis Fed conduct a survey in the other states in our region. The results I'll be showing you are going to be for the entire 9th Federal Reserve District. A lot of the respondents are from Minnesota because Minnesota is about half of the economy of our full district. If you're interested in the results just for Minnesota, DEED will be putting out their release today as well, and you can see that on their website. But they're broadly similar because a lot of the respondents were from Minnesota. All told, we had just about 300 respondents this year. And again, we do this survey on an annual basis, and what we ask them about is what happened over the last year for your business and what do you expect to happen over the next year, along with some other questions. And with that, I'll get into the results. You might wonder a little bit more about who it was that was responding to this survey. So we do ask some demographic questions about firm ownership. As you can see, the largest share of the firms that responded to this survey selected kind of none of the above. We ask whether these are minority or women-owned businesses or veteran-owned. A decent share, just about 28%, were women-owned businesses. Under 10%, it's about 6% were minority-owned. Larger share were veteran-owned, but the largest share of these firms selected none of the above in this category. So with that, what did they tell us happened over the last year? Well, this is a quick way of plotting these survey results. So we asked them what happened at their businesses and just simply whether these indicators went up, down, or were unchanged. And I plot these here as a diffusion index, which is a way of summarizing these results such that any value over 50 indicates that on average or on balance, the business has told us that this indicator increased over the past year. Anything below 50 tells us that on balance, those indicators contracted over the past year. And what you can see from this is that it was sort of a modestly up year, particularly for sales revenue. And that's obviously of key importance to these businesses, whether they're seeing demand. Profits were down on net during the year, but we saw productivity and employment also increase slightly, and then big increases in both the input costs of doing business, that is the non-labor input costs, and then selling prices as well, the prices that they were charging to their customers. We also asked them some detail about what their compensation costs are as well. And if you're interested in those, you can find those on our website. But a quick, on the release that comes out later today, but a quick summary of those is that on average, they told us that wages for their firms went up about 3% over the past year, which was a lower rate of increase than the previous 2 years. So consistent with some softening or moderation in labor market conditions. But again, overall, what these businesses saw over the last year was mild growth or modest growth, and then again, continued strong increases in prices over the past year. Where does this fit kind of in terms of what we usually see in this survey? Well, we've been conducting this survey for a long time, more than a dozen years now, along with DEED, and you can kind of see where these results fall, again, on this diffusion index scale. So anything above that solid bold line in the middle there is in expansion territory. So just showing you the kind of the history of what we see for sales and employment, kind of two of the most key indicators from this survey. Increased relative to last year. Both years were in expansionary territory. but just sort of mildly in expansionary territory. And you can kind of see how it compares to the history of the survey the last couple of years, seeing growth in sales and growth in employment, but down relative to or sort of low relative to a few years ago and relative to the middle of the last decade. Certainly still, though, in growth territory, which is a good thing as far as these businesses are concerned. We also asked them, and I think one of the more informative aspects of the survey is we asked them about their outlook for the coming year. Same indicators, but we're asking what their expectations are. And again, I put these as maybe a little bit confusing. You see that I have the 2 years listed. That's because we conduct this survey in the middle of the year. So we're asking them of what happened over the previous 4 quarters and what they expect to come over the next 4 quarters. So that's why I'm giving you a 2025 and 2026 outlook. You can see I'm just comparing to the outlook from a year ago, broadly similar outlook to 1 year ago. So even though we saw relatively mild growth over the past year, these firms are pretty optimistic for the coming year. Larger share of them are expecting their sales revenues to increase over the coming 4 quarters. Actually, positive outlook for profits, even though we saw profits decrease on net in the last year. They're expecting profits to rebound into positive territory slightly on balance. And that is a stronger outlook than a year ago. And you can see that a few of these categories are stronger outlooks than a year ago, productivity and employment as well. Again, continued expectations for relatively strong price growth. The labor availability picture is interesting. You can see that firms still told us that it got lower over the last year. It's getting closer to neutral for the year ahead. And again, that seems consistent with some easing in the labor market. But I'll show you in a minute some of the results from a special question we asked on labor conditions, which indicate that even though labor might be getting slightly more available or getting closer to neutral in terms of labor availability, these firms are still experiencing a pretty tight labor market. So that's the kind of outlook for, again, headline here, I would say, is pretty similar outlook relative to a year ago, and a positive outlook relative to what they told us happened over the past year. And again, this is just to kind of give you an idea of what the expectations typically are. Tends to look pretty similar to what transpired over the past year. So this is just a history of what the year ahead expectations were for sales and employment. Again, positive for the year ahead and roughly in line with last year. One of the things we also ask about is what effect credit conditions are having on firms. Overall, I would say the results of this question indicate that there's relatively minimal impact of credit conditions for most firms. This is something we ask about every year. Obviously, if pretty crucial interest right now, given the relatively high rate of interest that most firms are paying on credit on loans. But you can see just about half of them told us that they didn't experience any changes in their business due to credit conditions over the past year. So just a slight majority of them telling us no change. And then the next highest share, just over a third, told us that they were paying higher interest on their loans. So that's kind of the thing that pops up the most. But again, in terms of ability to access credit, more than 20% of us told us that 20% of these firms told us that they had no difficulties accessing credit. A lot of them simply weren't borrowing, so they're not gonna check that box. Some firms telling us that they're decreasing their capital expenditures or hiring as a result of credit conditions, but they're down below 20%. They're in the kind of the mid-teens in the percentages. So overall, fairly stable, fairly minimal impact that we're seeing in terms of credit conditions from the businesses in the survey this year. One of the things we also ask about is outlooks for state economies over the coming 12 months. So everything I've been showing you so far is what they're telling us they expect for their businesses over the year, or what happened to their businesses over the past year. But we're also interested in their overall economic outlook. That is actually a little bit more pessimistic for the year ahead, and that's consistent with what they told us a year ago as well. So you can see the 2025 outlook for most of the categories. We ask about employment and consumer spending, corporate profits as well. Even though they're expecting their own profits to be positive on balance in the coming year, they're expecting overall profits for businesses in general to be down over the coming year. Employment, they're expecting to be down over the coming year. And again, I'm comparing their outlook from this year's survey to the outlook that they gave us a year ago. You can see they're pretty similar. They're also expecting inflation to continue to increase, or to continue to the price growth to continue to increase over the coming year. And so overall, economic outlooks not as strong as their outlooks for their own firms. That's not unusual for these surveys. These firms tend to be a little bit more bullish for themselves than they are for the economy overall, but it's worth noting. And then one last thing I'll get into before we get into the Q&A portion of our show this morning. I did want to leave a good amount of time for audience questions in case there are any. I see that we are getting some comments in the chat, but I did want to share with you the results of an ad hoc question that we asked about this year on this year's survey, because we are seeing some indications from anecdotally from some businesses, and then also some signs in the data of some moderation in the job market. Kind of, again, not a contraction in the labor market. We did see, again, in this morning's job report, we saw positive growth in employment, but at a lower rate than we've typically seen over recent months. So we wanted to ask them about what they're experiencing on a broader level in terms of labor availability and labor market indicators. And you can kind of see how this breaks down here. Most of these firms, even though they told us that labor availability improved, they were hiring on balance. And then in some of these categories for labor market indicators, they're still telling us that the labor market is pretty tight. So even though they might say, some of them might say that things have improved in terms of their ability to hire, on balance, there are more of them telling us that turnover increased since the beginning of the year than decreased. And we are referencing, just for this question, I wanted to reference just the beginning of 2025, just to kind of get a sense for what's happened a little bit more recently. The rest of the questions on the survey are on a year-over-year basis. A large share of these firms told us that they're increasing their usage of automation or AI. We put that as one category, so we don't know which ones are automation and which ones are AI. For professional services firms, there's probably some overlap between those two. So that was the largest share indicating increases. And then the number of applicants for open positions was one where we had more than 40% of firms actually told us that those decreased over the past year. So again, even though anecdotally some firms in other industries have told us that they've seen an increase in applicants, an increase in labor availability, and for the professional services sector in our part of the country, we are still seeing a pretty tight labor market. Again, there's more detail about this that you'll be able to find on the report that comes out on our website. But again, just to kind of go over these, we're still pretty strong wage demands by applicants, remote work and benefit demands by applicants up on balance as well. And on the labor demand side as well, these firms are telling us that they're on net, their number of open positions has increased as well. So for the firms in the professional services sector, still a somewhat tight labor market. With that, I am going to turn it back over to Haley to see if there are any questions from the audience. And I'm just going to leave up that QR code here in case you want to scan that and consider joining our Pulse survey.
Great.
Thank you.
Thanks, Rob. So yeah, if you have any questions, please type them in the chat box on Zoom. I've seen a couple come in so far, and let's start with this one. Do the results on the labor market signaling that it's still pretty tight seem inconsistent with what the preliminary employment statistics are showing, that conditions have softened recently?
Yeah, that's a good one. I talked about that a little bit already, but just to sort of elaborate. So I'm going to go back to this chart here. Yeah, you can see again that on balance, they're telling us that they're seeing fewer qualified applicants for open positions. Now we threw in the qualifier qualified, and so we don't know whether the total number of applicants is up or down. That's, I think a lot more relevant to these businesses. The way I would interpret this is not being in conflict with what we're seeing in some of the macroeconomic data about, so for example, in the aggregate data, we know that the number of job openings relative to the number of people in the labor force has come much more into line than it was a couple of years ago. So a couple of years ago, there was a really big gap between those two things. There were a lot more job openings than there were workers to fill them. Now those two are somewhat more in balance. Unemployment is still really low, so we know the labor market isn't a weak labor market right now by any means. But again, just kind of some moderation we've seen in the labor market over the last couple of years. Firms in the services sector maybe not seeing that as much, and that I think owes to two things. I think there's two things that might account for the difference that we're seeing in at least in this survey question. And that's first of all that we're in a part of the country where the labor market is just generally tighter. So we're doing this survey in the 9th Federal Reserve District. Some of the states in our region have some of the lowest unemployment rates in the country, highest labor force participation rates in the country when you look at states like Minnesota and North Dakota, and lower rates of growth in our labor force as well. So this has just been an ongoing structural issue here that the labor market is tight regionally in this part of the country. And then in these particular industries as well, these are industries that a lot of them are, they're hiring skilled professionals, people with advanced degrees and things of that nature. Certainly when you're talking about engineering and design work or scientific laboratory services, there are businesses like that. They're hiring people with advanced degrees. And so the labor market for those positions is currently, at least, I think, probably a little bit tighter. And so I think that might account for some of the difference. And one more thing I'll say about that is if you just look at the normal, every year indicators we ask about labor availability, like I said, even though they're telling us labor availability went down on balance, we had a much larger share of firms telling us that there was no change in labor availability than we normally see in the survey. And that's consistent with kind of sort of a general moderation in labor market conditions, I think, that we saw in the typical results that we get for the survey. This question got into a little bit more detail, and so we got a little bit more nuance in this question. And I think that accounts for some of the difference as well.
Great. Yeah, that makes sense. We've had a few kind of technical questions come into the chat. Someone was wondering, where does software, IT consulting, digital systems fit into the NAICS codes?
Yeah, that's a good one. So information is sort of its own category in the NAICS codes, not included in this. So I'll go back up to my breakdown of GDP here. You can see that I have this broad category called other services here. And that's going to include information services. So even though there are a lot of firms in the professional and business services sectors that we're surveying here that are doing IT type of work or that are IT heavy, they're not primarily specializing in that. They're primarily specializing in selling services to businesses or providing other scientific or technical services like legal services and things of that nature. So those are not included in this particular survey sample.
Okay, great. And someone else was wondering if you could confirm an earlier stat that Minnesota accounts for 50% of the district's economy.
I said it was roughly half of the district's economy, and I don't want to confirm that because I don't have the breakdown of GDP by state. The other thing that's I should just to be transparent about this, that tabulating any economic statistic for the 9th Federal Reserve District can be a little challenging because we only have portions of Wisconsin and the Upper Peninsula of Michigan. Typically, what we do as a sort of rule of thumb or a sort of heuristic way of summarizing that is we'll include Wisconsin because we have a large portion of Wisconsin, but not include Michigan because the Upper Peninsula of Michigan is only about 3% of Michigan's population. And so that's actually what you're seeing here. I'm counting the whole state of Wisconsin and none of Michigan. So thank you for asking about that because it's not really a true 9th district GDP because that would require getting down into the county level, and those data are a little bit less timely to access, we'll say. And so yeah, that's so in terms of the total economy of the 9th district, I can tell you that if you go by the actual population of the counties in the district, Minnesota's population is just about half of the population of the 9th district, slightly more than half actually. But in terms of its GDP share, it's roughly about half, but certainly not, it's not a clean 50%.
Yeah, got it. And then someone else was also wondering, we have a lot of questions about the impact of tariffs on business. Does this survey shine any light on that?
So interesting question. We thought about asking about tariffs. We have the opportunity on the survey form every year to put in a special question. I went through the results of our special question this year, which were about labor market indicators. We thought that was maybe a little bit more relevant just because the particular businesses that we're surveying for this survey are maybe a lot of them you might assume not as exposed to trade. In fact, we do ask them about their exports. That's one of the regular indicators we ask about. A little bit more relevant for our manufacturing survey. A lot of the firms that fill out this survey don't answer the export question. They just leave that part blank because they don't do export business. Some of them will even write down on the survey, don't export. However, a lot of them do source inputs from overseas, particularly if you're thinking about lab work, medical, certain kind of medical adjacent type of businesses that are sourcing inputs, whether they're sort of more packaging or maybe in some cases more advanced machinery from overseas. And so we are going to see impacts, I think, in that regard in terms of the inputs to this business. So why am I belaboring this point? What I thought was interesting was even though we didn't ask about tariffs on this year's survey because we thought, well, we're still not sure what the impact of tariffs is going to be yet, and these are maybe not the firms to ask since they're not as exposed to international trade as some other sectors. We did get a lot of unsolicited comments about tariffs. So a lot of businesses were telling us that tariffs are impacting them. And I don't want to overstate this. These are people voluntarily saying, tariffs have, a couple people mentioned, for example, that tariffs are causing a lot of uncertainty for businesses right now. We certainly hear that a lot anecdotally, but we don't have any kind of core survey results on the impact of tariffs to share, other than maybe you could potentially read some of the increase in input costs could potentially be due to tariff impacts, but I wouldn't want to overinterpret that. Overall, I would say we did get a lot of unsolicited comments on the impact of tariffs. They were mostly pointing to uncertainty or concern. A few comments that were positive as well, but that was sort of on a voluntary basis that the businesses responding to this survey were putting in. So certainly nothing, nothing like scientifically rigorous that you would want to read into that.
Got it. And it looks like we have time for probably about one more question. Someone was wondering, have there been any comments about professional services being negatively affected by AI?
Yeah, we didn't get any comments on that on this year's survey. Yeah, what's interesting is, you might think that there are possibly even businesses that are deciding to exit because of perhaps services that they're using becoming less in demand or becoming outmoded due to artificial intelligence, but then those businesses aren't responding to the survey. And so we don't really know what we don't know in this regard. I did think it was interesting that, you can see I actually have the slide up right now. Nearly 2/3 of businesses, it was 65% actually told us that they are increasing their usage of automation and AI. If I had to guess, a lot of this is probably usage of the large language models for automating certain tasks like, I don't know, maybe data processing or writing emails, writing copy, things of that nature. You hear a lot about a lot of business use cases for large language models. I would guess that on balance, that's what we're hearing about here with regard to automation. Like I mentioned earlier, when you're thinking about services, obviously in a manufacturing context, automation and AI are two different things. In business services, AI could be a form of automation, right? So that's why we kind of lump them together on this one question. Not exactly sure about what the sort of negative impacts of AI might be on some of these businesses, but certainly you can imagine that in certain, in maybe design and graphic design in particular, some of these firms could be seeing less demand for that sort of thing because their clients are deciding to outsource some of that to data centers.
Got it. So that's our last question for today, everyone. Thank you so much for joining us. And please join us for our next virtual event, Regional Economic Conditions General Business, on Tuesday, August 12th. More information will be in our follow-up email to this event. And with that, I hope everyone has a really great day.
Thank you.